Daryl, good to have you back on ET now. Thank you for joining us. Daryl, first the big global question. Is the dollar's short trade reversing, and is it time now to sell commodities?
Is it time to sell commodities? What's happening with commodities is we have major regulatory risk. And we talked about this 6 or 7 weeks ago. Remember when Ben Bernanke gave his address in Georgia? Everyone expected him to talk about QE2 or QE3, but instead he talked about clearinghouses. That gave us clear warning that what was on the agenda in the coming weeks was changes to the way the clearinghouses are operating. The 5 margin increases in silver in the last week, with one coming tomorrow morning, an increase in margin rates with MAS in Singapore, showing us that we have regulatory risk. This is going to lead to a substantial sell-off in commodity markets, but it's driven by regulation, not by changes in supply and demand.
Daryl, hi, morning. India is down about 9% on a year-to-date basis, while other markets are up about 7-8% in US and Europe as well. Do you think Indian equities would play catch-up for the next few sessions?
No, I think in the next few sessions the catch-up is likely to be on the downside rather than the upside. So if you're looking at Nifty, for instance, we are sitting at about 5,400 now. We nearly need to hold support at around 5,200. That short-term uptrend that was in place last week has been decisively broken with the changes to margin increases that took place in the United States. So there's a contagion coming across markets. We will see this feed through to equity markets. We'll see it feed through to commodity markets as those people who own exchange-traded commodity funds start to redeem funds in the next 2 or 3 days.
Right. So, Daryl, what's your bear case scenario for Indian markets for the year 2011?
2011. Okay. I don't generally look that far out. What I'm interested in particularly is looking at trends that are lasting 3 to 4 weeks, 3 to 4 to 5 to 6 months. The key resistance level in the Nifty is still around 6,200. We can see this as part of a longer-term upside consolidation. In other words, coming back to around the 5,200 level, developing a rebound from that for a retest of 6,200. In the longer term, the pull-off in commodity prices is a deflationary effect that overcomes a range of factors that we have in terms of inflation across Indian markets and other markets. So that's a positive for markets. So in the longer term, towards the end of 2011, I see the Nifty and the Sensex as moving higher, but it's not going to be a smooth ride.
Daryl, what about key names on the index like Reliance and ONGC? What are they telling you, the charts?
Key factor with Reliance and ONGC is you have to trade them as individual stocks. What we're seeing is a separation between the behaviour of the index and the behaviour of the stocks within the constituents of the index. In the past, if the index went up, then there was a fairly high probability that most of the stocks in the index would have the same type of behaviour. But what we're seeing across all indices, not just in the Sensex and the Nifty, but across all other indices, in the Kospi, for instance, is that there is now greater variation in the behaviour of the stocks that make up the index. It's an increase in volatility. This means that we now have to take individual positions in those stocks, treat them by themselves rather than looking for them to follow the index behaviour. If you want to trade the index, you trade it through an ETF. That will give you a much more accurate approach. So ONGC, we need to see it develop and sustain that uptrend. With Reliance, we're looking at pullbacks from the existing tops. What's important with Reliance now is to locate where the support levels are and look for a rebound.
Right, so Daryl, a long trade for our viewers which is valid for next 15 days.
I'm sorry, I didn't quite hear you.
A long trade for our viewers which is valid for next 15 days.
Next 15 days, I'm tightening stops all the way through. At this stage, my preference is to be short rather than long. If I'm still in a long position and that trend is intact, then I'm tightening stops. Now, tightening stops means I'm using something like 2 times ATR, shift that back maybe to 1.5 or 1 times ATR. That lifts the stop loss up. Or use a price volatility stop line like a countback line. Again, lifting the stops so I'm protecting my profits. That's the key factor. If I'm opening long positions at the moment, or I'm opening positions, I'm opening short. I'm not opening long.
So, Daryl, are there any individual names on the Nifty that you would want to short right away?
I don't have those charts sitting right in front of me at this point in time. That's another part of my task for later on this afternoon, to look at some of those opportunities. But what we're looking for in each of those is 2 things. First, the development of pre-existing end-of-trend patterns. Now, these are rounding tops and head and shoulder patterns. We're seeing these in a number of stocks. They give us clear downside targets. That's the first thing we look for. The second thing we're looking for is these volatility spikes. In other words, an existing uptrend that's been well established where the downtrend or the down spike started on Friday in response to what was happening with silver in particular. they are likely to continue to fall a great deal further. We look at not the first support level as those targets, but the second lowest support level. The key factors I'm looking for are stocks that fell heavily on Friday. I will go back into those and continue the short, or stocks that have an existing end of trend pattern, head and shoulders or rounding top, that gives me downside targets to aim for.
Right. Daryl, whereas you're making a point that it makes sense to open short trades, I just read your blog, and on your blog you're writing that it makes sense to go long on crude.
But that blog was written before we had the margin increases coming through in silver. And the margin increases in silver are a game-changing environment. It's a regulatory risk, which we identified in that same blog about 6 weeks ago. So once that happens, you have to move quickly, because the danger is that, okay, they've increased the margins on silver. When are they going to start increasing the margins on gold positions? How will they transfer through to copper positions? How will it transfer to the speculative markets in the commodities where the speculators have been active, particularly through exchange-traded commodity funds? Raising the margin rate is a way of taking that steam out. It started. So we can no longer rely purely on technical analysis on that. We have to factor in this new regulatory risk. That's the fact that starts this week.
Right. So, Daryl, I'll keep this one open. You pick and choose your number one short idea across all asset classes.
Number one stock idea, all asset classes. I'm trading commodities. I'm looking at trading on the short side for a continued fall in silver. I'm happy to trade on the short side for a continued fall in gold after the initial rally. Because what we're going to see, I suspect, is an initial rally taking place today, tomorrow. As US markets open and that sell-off continues, then the downtrend pressure is in place. So I'm looking for rebounds as a short side entry opportunity, particularly in the commodity space. Individual stocks that are heavily exposed to particular commodities, through to silver or to gold, they can react in the same way, but I'll trade those with a derivative to leverage the impact of those results.
Daryl, what about individual stocks like Bharti Airtel and Tata Motors?
They're still useful trading opportunities, but I feel that the primary opportunities are going to come from the volatility that is moving into the commodity space. Bharti Airtel, for instance, they're a stronger trending type of stock. There will be some reaction to the overall market reaction, but the strongest reaction and the tradable reaction comes from those that are most directly involved in the commodity space. And this will tell you very quickly who is hedged out and who is unhedged. Those who are hedged out will have less reaction than those companies which are largely unhedged. The unhedged companies are the ones that are going to give us the largest reactions and the largest tradable reactions.
Right. So, Daryl, on a scale of 1 to 10, what are the chances that Nifty could slip below 5,000 in next 3 months?
A scale of 1 to 10, what's the sort of probability I don't normally work at? There is a lower probability that the Nifty will slip below 5,000. If it does, it has a good support level at around 4,800. The key factor we're looking for this week is the ability of 5,200 to hold. If 5,200 doesn't hold, then 4,800 is our next downside target. Look at the Nifty. There is no strong end of trend pattern in place. There was a small head and shoulder pattern that developed, which we talked about 8 weeks ago, and that gave us a downside target around 5,200. So the rebound that's taking place and the retreat is part of that longer term pattern. So there's a lower probability, scale of 1 to 10, let's say 20%, that we will fall through 5,200 and hit the 4,800 support level.
Right. So, Daryl, correct me if my interpretation is wrong, but are you trying to send a message across that our viewers who are long, they should cut their longs, and at higher levels across all asset classes, they should actually initiate fresh shots?
My message, if I'm going to sum it up, is that you need to protect profits in long positions. You do that by tightening stops. That's number one. Number two, that if you're opening new long positions in this environment, treat them as short-term rallies at this point in time, again with very tight stops to protect capital. If you're opening shorts, the best place to open shorts at this stage is not to join the downwards momentum, but to wait for a relief rally to develop and then short the relief rally. Now that's going to be probably Tuesday or Wednesday before you put that strategy into operation.
Daryl, before we let you go, what do you make of the kind of uptrend that we've seen in gold?
Uptrend in gold is sustainable in the long term, but we're going to see an increase in short-term volatility. So in terms of the uptrend in gold, The biggest fear is this contagion across the markets that there will be increases in margin rates, and not just the occasional increase. One of the questions that we're writing about in the column in China Daily today is whether in fact we can call this market manipulation. 1 or 2 margin changes is okay, but 4 margin changes within 7 days, that smacks of an attempt to influence the behaviour of the market rather than allowing it to reach its natural levels.